Did you know that when Michael Burry successfully predicted the 2008-09 housing and stock market crash, he was harassed by the government and had to pay $1 million in legal fees to defend himself? Instead of recognizing his efforts that warned millions of Americans about the upcoming perils, he had to suffer both mentally and financially. The United States government should have made him their lead economist. Listen to what he said.
I saw the crisis coming. Why did not the Fed? Never did any member of Congress, any member of government for that matter, reach out to me for an open collegial discussion on what went wrong or what could be done. Rather, within 2 weeks, all 6 of my defunct funds were audited. The Congressional Financial Crisis Inquiry Commission demanded all my emails and lists of people with whom I had conversed going back to 2003. And a little later, the FBI showed up. $1 million in legal and accounting costs and thousands of hours of time wasted, all because I asked questions. It seemed they would pump me at gunpoint or not at all.
Well, today I'm getting the same feelings. No one's listening to what Michael Burry is warning about. U.S. and global economy is facing a great peril again. Doesn't matter if all the economists agree or not on whether the U.S. economy is going into recession or not, but one thing is certain, and that is that the economy and stock market is making no sense at all and is screwed for the foreseeable future. The negative, or in some cases zero, growth in corporate earnings is making a global recession increasingly more likely. Even J.P. Morgan recently warned that the market can even fall further another 20% from the current levels. With recent sideways volatile movement, stock prices have started to behave in an unpredictable manner, going down sharply some days and then rallying the very next day. While everyone seems confused about recession, stagflation, hyperinflation, or crash, Dr. Michael Burry is once again standing out with his latest clear-cut prediction. Being a contrarian, he saw the subprime crisis coming before anyone else. Now, Michael Burry has been arguing that the inflation will get even worse from here and will erase all the market gains that people might have made in the last several years. And surprisingly, this is just the beginning. There is no end or bottom in sight. Let's talk about what's going on right now, why the stock market is experiencing a sell-off, and what's the latest warning Michael Burry pointed out. Looking at the current trading environment, Michael Burry warned investors that they shouldn't get their hopes up about any rallies in the ending winter quarter, as there are likely to be brief respites that won't result in a market recovery. Market rally refers to the increase of the stock market at least 5% in the middle of downtrends. During a bear market, it's a common practice. The bear market between 1901 and 2015 spawned at least one 5% rally. Rallies of 10% or even more interrupted 2/3 of the 21 bear markets over that time span. Now, given the current scenario, it's evident that history is repeating itself. It can also be seen that the deeper the decline, the harder the rebound will be. For instance, in 1929, the Dow Jones surged around 48%, while earlier it fell 86%. Similarly, the dot-com market also had 8 bear market rallies of 18%, including 4 gains of almost 30%. But before then, they dropped even lower. The great financial crisis of 2008 also came across 9 bear market rallies between 6% and 24% before they reached the bottom after a couple of years. On the bear market rally, Michael Burry pointed out that since the market peak on December 31st of last year, we're observing a pattern of falling 8 to 10% and then rallying 5%. Again, falling another 8 to 10% and then again rallying 5%. However, Michael Burry noticed that, now quoting, "Dead cat bounces are the most epic. 12 of the top 20 NASDAQ one-day rallies happened during the 78% drop from the 2000s top. 9 of the top 20 S&P 500 one-day rallies happened during the 86% drop from the 1929 top." He also shares that the Dow has 10 bear market rallies. Therefore, more than 10% before bottoming down to 89% in 1929. He suggests it may take some time before hitting the bottom. Historically speaking, there is no bear market having bottomed without a certain fixed reading of 45% or more. Recent history proves the same. You can well observe that VIX hits a peak of 70% in November of 2008 before hitting the bottom after only 3 months. VIX hit 57% and 65% at exactly the same time that we saw March 2020. To determine the bottom of the stock market, Michael Burry has several other points that are worth considering. First, he says that 13% of stocks have closed above their 200-day moving average. Usually the absolute bottom takes place when the number is closer to 5%. Again, this was seen throughout 2009, 2011, and 2020. The only exception has been the dot-com crash, and that was basically centered on a higher growth tech stocks. Secondly, he mentioned that there are 218 companies which have a worth of more than $1 billion that are losing $100 million annually. Also, there are 29 companies with a worth above $10 billion. It's a market cap which cannot turn out profit. These companies include Uber, Snowflake, Lucid, Rivian, and Shopify, among other dozens of names. If the same trend tends to continue, we will observe the same pattern like in 2008, where the market did not bottom for another couple of years. Then, to make things worse, inflation will spike again and again. As he said, quote, "It resolves, fools people, and then comes back." The charts show that since 1940, inflation did not occur once and then disappeared completely. All this is because of the back and forth of the money velocity. For example, if you spend $10 at a restaurant, who then pays $10 to the server, who spends $10 at a grocery store, who then pays $10 to a wholesaler to pay for more food, who then spends $10 to a farmer to make the food, who then pockets the money to make an investment in GameStop. All this works out to be a money velocity of 5, since it changes hands 5 times. This shows how often every dollar is spent and then recirculates throughout the economy. This is why Michael Burry says that the Fed is taking money out of the economy with higher interest rates. The average dollar is spent more frequently with higher money velocity. And because of all this, inflation will continue to go higher. Michael Burry also explains that this will be adding more and more pressure to the housing market. It is where 1 in 10 houses are slashing the prices at a highest pace since 2015. However, there is good news as well that this is a great opportunity to buy. If we don't add the drop of less than 20% average, the bullish market lasted for over 9 years with an increasing return of 476%. On the other hand, if we include the 20% declines, which seem to be minor along the way, the average bull market still lasts for an average of 4 years with snowballing returns of 129%. The Wall Street Journal published an article saying that we're heading towards a bear market rally. It observed that since 1990, the biggest rebounds are observed after they've had the worst falls. However, it still does not mean that the coming bull market will last 2 years. This is because if we go back in history, since 1940, the shortest bull market was just after the dot-com crash. This was the point where the market spiked up to 21% over 3.5 months before it declined 34% over an upcoming 9 months. Then there was a period of 1.5 months during the Great Recession when stock rose 24% before falling 27% a couple of months later. Though it is an agreed upon fact that bull market lasts longer as compared to bear markets, such levels of volatility are normal. Drops, as well as gains of 20%, are seen on a regular basis. It's also seen that during the bear market, stocks lose up to 36%, while gaining 114% during a bull market. It is in terms of Burry is doing. He thinks that, quote, "Free cash flow totally on sale and ignored, while former momentum stocks are coming down, but not far enough. And darling businesses still had a ways to fall. Value was about to take off for years, despite more crash on the way." He suggested that boring businesses are the ones that will actually outperform in the short term. An oversold condition in the stock market can act as a catalyst for a moderate rally. Better than expected earnings can act as a trigger for a market rally. People are spending more money, or reduced inflation in coming months. Home builders are gaining more and more confidence. Therefore, be cautious in such a market and plan for the worst. However, don't adapt your investment strategy around the plan that it may or may not happen. We've seen more people losing money planning for the crash, which is inevitable, as compared to those who consistently buy in dollar cost average without thinking what will happen. The main focus must be to see ways to increase your income as much as possible over the next 1 or 2 years. Even if the market drops, you have enough resources to take advantage of lowered prices.